Yes, welcome students again. Today I'll give some tips and advices on a very important chapter, which is national income. In the first part, actually national income, this is a block consisting of 3 chapters. The first one is circular flow of income. In this circular flow of income, do all the 3, that is 2-sector model, 3-sector model and 4-sector model. See, you have to concentrate on the diagram of circular flow of income firstly, and when you are drawing it, please in the diagram please demarcate, that means real flow and money flow. You can indicate the money flows by dotted line arrows and indicate the real flow by solid line arrows. Be it a 2-sector model, 3-sector model or 4-sector model, you have to write in the explanation, the brief explanation that you are writing about savings and investment. That savings is a leakage because the money is withdrawn from the circular flow, and investment is an injection because the money is put into the circular flow of income in the country. So these are must to be written. Now also learn the definition of circular flow of income, because that can be asked, define or what is circular flow of income, and then the question can be given on any one, that means 2-sector, 3-sector or 4-sector model. Now we come to the second chapter which is regarding the national income aggregates, that is the different concepts: GDP, GNP, NDP, NNP, and at factor cost, at market price, all these. Now you must know the definitions of all these: GDP, gross domestic product, gross national product, net domestic product, net national product. Out of these, at factor cost and market price of these concepts, NNPFC is national income, that you all know. Now after that, after learning the definitions, then you learn from national income how to get private income, from private income how to get personal income, from personal income how to get personal disposable income or disposable personal income. You will learn the equation, that means how to get private income from national income or from NNPFC. See, NNPFC or national income minus income from property and entrepreneurship accruing to the government, that means all incomes going to government, minus again savings of non-departmental enterprises of the government. These two are deducted, plus, now addition, plus national debt interest on the national debt, plus net current transfers from the government, again plus at the end, plus net current transfers from the rest of the world. So this equation you need to learn, you need to remember how to get private income from national income. Then from private income, how to get personal income. Personal income is equal to private income minus corporation taxes, minus undistributed profits, minus net retained earnings of foreign companies. That means from the private income, you are subtracting all incomes accruing to or going to or received by private enterprises. Undistributed profits and corporate taxes or corporation taxes, these two make what? These two make the income earning of the private enterprises, which are suppose domestic private enterprises. Also to be subtracted, net retained earnings of foreign private companies, that are also to be subtracted. So in this way we get personal income from private income. Now at the end, next is personal disposable income, DPI, disposable personal income or personal disposable income. Personal income minus personal taxes like income taxes, wealth taxes, property taxes, Minus again are the miscellaneous receipts of the government paid by the people. So personal income minus personal taxes, and again minus other miscellaneous incomes of the government from the people or by the people, by the private individuals. In this way we get DPI, disposable personal income, or personal disposable income. So these you need to remember. And again, after this, at the end of this chapter, you need to know GDP at constant prices, GDP at current prices. See, GDP, gross domestic product, when you are considering by taking into consideration the values of the goods and services which are prevailing in the current year, then you get GDP at current prices. GDP at current prices. Whereas when we consider GDP at constant prices, then we measure the values of the final goods and services produced by all the enterprises and individuals located within the domestic territory of the country during a particular year, expressed at the market prices prevailing in a particular year, a previous particular year, which becomes the base year. So that is GDP at constant prices. GDP at a constant price which existed, the prices of the goods and services which existed in a previous base year. So this is also a probable question. What is GDP at constant prices? What is GDP at current prices? Now after this, at the end of this chapter, or absolutely at the end of this chapter, you have another topic. Limitations of national income or GDP as an indicator of economic welfare. Basically, we cannot consider GDP or national income to be a true indicator of welfare, to be a true indicator of economic welfare. Now, why? What can be the reasons? Like national income or GDP or per capita income, does not provide full details about the composition of output. If the national income has increased in a particular country, GDP has increased. Why? Because output production has increased. But when output production has increased, maybe that production of harmful goods like drugs, harmful drugs, intoxicating things, cigarettes, alcohol, or guns and bullets, the production of these goods has increased. Then will that lead to any welfare of the people in the country? No. But that leads to increase in the national income, increase in the GDP. So this is one point, that national income or GDP or per capita income does not give us the true picture of the composition of output. Next is national income or GDP or per capita income also does not give the clear true picture about the distribution of income. Maybe in the country national income has increased, GDP has increased, but the basic thing, the true thing is, the practical thing may be that some rich people, their incomes have become much more, the incomes of the rich people who were already rich, their incomes have increased a lot, tremendously. And a very large number of people who were poor have become poorer. Then also we find there may be an increase in the national income or GDP. But this does not indicate, this does not reflect, this does not imply that economic welfare of the people has increased or enhanced. So this is another point. Next is how the GDP has increased, the manner of increase in GDP. This is also a factor because when GDP has increased, national income has increased, maybe because of industrialization. And when there has been rapid growth in industries, that has led to environmental pollution, polluted atmosphere, then too much of exploitation of natural resources, these have occurred. Then when these have occurred, at the cost of the environment, at the cost of these, GDP has increased, national income has increased. Then also we cannot say that people's welfare has improved or enhanced. So this is another point. Then we find another point you can write as some items are excluded. Some items are excluded from the GDP calculation. Yes, when calculating the GDP or calculating national income, some items are not taken into account. Like the non-market transactions. Some of the non-market transactions increase economic welfare, but they are not included in GDP. Non-market activities refer to those goods and services which are not exchanged in the market. Like you all know, because in some other chapters or in class 11 you have studied it also. The activities of the working of the housewives, that really creates welfare of the family members. So welfare of the people in the country overall, there the contribution of the housewives is a lot. But are the housewives paid? Do the housewives earn? No. Then that activity or those activities of the housewives which create economic welfare, which increase economic welfare of the people, it's not included in the national income because there is no payment. So this is another point which can include. So these are to be studied from the chapter National Income Aggregates or the concepts. Now we come to the next chapter, which is methods of measuring national income. Yes, this chapter, you will be able to understand this chapter, and definitely sums, numerical sum on the basis of the methods will come. Expenditure method, income method, value added method. One of these, or a numerical sum combining any two methods also can come. You need to have a very sound knowledge, proper sound knowledge about these three methods. Expenditure method, let me in a nutshell, let me tell you. C plus I plus G plus X minus M. Private final consumption expenditure plus gross domestic capital formation or gross investment expenditure plus government final consumption expenditure plus net exports, that is exports minus imports. What we get? GDP MP. Then GDP MP minus depreciation or consumption of fixed capital, you get NDP MP. Then NDP MP plus NFIA, net factor income from abroad, you get NNP MP. And NNP MP minus net indirect taxes, that is indirect taxes minus subsidies, you get NNP FC, which is national income. These are the basic steps in expenditure method. Now there can be some modifications in the question, like instead of giving in the data gross domestic capital formation, it can be given net domestic capital formation. If it's given net domestic capital formation, then private final consumption expenditure plus net domestic capital formation plus government final consumption expenditure plus net exports. Now you get NDPMP directly. So directly in the first step you are getting NDPMP. Now NDPMP, after that the next two steps, as you know, NDPMP plus NFIA is equal to NNPMP, and at the end NNPMP minus net indirect taxes is equal to NNPFC, that is national income. So this is the basic expenditure method. Now again another modification. If in the sums data, the entries, if it's given change in stock, then when you are taking into account, taking into consideration C, I, G, X minus M, that is C plus I plus G plus X minus M, you're getting GDPMP. If it's gross domestic capital formation, you're getting GDPMP. You're getting GDPMP. Now, if it's given the data, change in stock, then you have to add that also. So C plus I plus G plus X minus M plus change in stock, you get the same thing, is equal to GDP-MP. And then the next steps will follow, same steps. Again, if it's net domestic capital formation, and again change in stock is given. So private final consumption expenditure plus net domestic capital formation plus government final consumption expenditure plus net exports plus change in stock. Then you get NDP-MP. And then the next steps will follow as it is. So this is about expenditure method. Now we come to income method. The basic steps in the income method, what is that? Compensation of employees. Now one thing, please do study the components of compensation of employees. What does compensation of employees mean? What does it consist of? Like basic salaries and wages, supplementary labor income, payments in kind, and the examples of each. Now in the method of income method, the steps is compensation of employees plus operating surplus. This operating surplus consists of what? Rent plus interest plus profits. Because operating surplus is the income earned from assets, capital, properties, and entrepreneurship. That is why operating surplus is what? Rent plus interest plus profits. So compensation of employees plus operating surplus plus mixed income of self-employed is equal to what? Is equal to NDPFC, which is also called domestic factor income. So by this first step, you are getting NDPFC. The next step is NDPFC plus NFIA. You get NNPFC. So only two steps. Now here, in the questions entries, instead of giving directly profits, if it's given corporation taxes, dividends, and undistributed profits, then we have to add these three components, and then by adding these three components we get profits actually. What happens is the private company, from the profits earning, firstly it gives the corporation taxes or corporate taxes to the government. Then what remains from the profits, from that it gives the dividends to the shareholders. And then what remains after giving all those from the profits, that is undistributed profits. So in that operating surplus component, that component profits, if in the questions entries, it is split into three parts. That is dividends, corporation taxes, and undistributed profits. Then you add these three and you get profits. So that is about the income method. Now we come to the value-added method, or product method, or net output method, or production method. Several names of the same method. In the value-added method, the steps will be total value of all final goods and services produced in primary sector plus secondary sector plus tertiary sector, minus total value of intermediate consumption in primary sector plus secondary sector plus tertiary sector. That means total value of goods and services produced in the whole economy minus total value of intermediate goods and services, intermediate consumption in the whole economy. What do we get? Gross value added. Gross value added at market price or GDP-MP. Now, in the next step, this gross value added at market price or GDP-MP minus depreciation or consumption of fixed capital plus NFIA minus net indirect taxes. Yes, you can write all together. You get national income or NNPFC. Or you can split up and write like gross value added or GDP-MP minus depreciation or consumption of fixed capital. You get net value added or NDP-MP. Gross minus depreciation is net. And then the next two steps, that is NDP-MP plus NFIA is equal to NNP-MP. And then the last step, NNP-MP minus net indirect taxes is equal to NNPFC. If you remember these three methods stepwise like this, any numerical sum given to you, you can answer. You can solve the sum successfully, correctly. I would advise you to attempt. This will be compulsorily there in the question paper. So in the ISC board exam, these numerical sums are very important. Now we come to certain other questions in this national income, like what is double counting, the error of double counting, and what does it lead to? And what does it lead to? See, in GDP, GNP, NDP, NP, when you are learning the definitions, you learn that we are taking into consideration total value of all final goods and services. Yes, final goods and services. We do not take the intermediate goods and services values. Now, if by mistake the intermediate goods value is taken and the final goods value is also taken, then that will lead to the error of double counting of the value of the intermediate goods. Like, if we take into consideration the value of a car is the final product. Yes, we have to take into consideration only the value of the final good, that is the car. If we take into consideration the value of the tires and also the value of the car, then that will lead to error of double counting. What is counted double? The value of tires is counted double. Once included in the value of the car, and again if the value of the tires is taken separately in the calculation of national income. So this is the error of double counting. And what does it lead to? It will lead to an exaggerated value of an increased value of the national income, which is not the correct figure. So this is what is the error of double counting and what does it lead to. Now in this the last chapter of national income, that is the methods of measuring national income, precautions and difficulties of each of the three methods, that is very, very important. Precautions and difficulties. Like several items can be given to you, and you will be asked which of the following items will be treated in national income accounting, national income calculation, and which are not to be considered. Then you need to know which items are not to be taken into account and which items are to be taken into account. Then some other questions like, who are the normal residents? Who are the normal residents, or who is the normal resident of a country? Normal residents are those people who ordinarily stay in the country, reside in the country in which they live and whose economic interest lies in that country. So this can be a short question, who are normal residents? Next is national income a stock or flow? Is national income a stock concept or flow concept? Definitely national income is a flow concept because it is measured over a period of time, that is 1 year. Okay. Now next, another type of question, I said that the precautions and the difficulties you will study. Next it can be, what is GDP deflator? I have already told you about that GDP at current prices, which is called nominal GDP, and GDP at constant prices, which is real GDP. Now GDP deflator is actually a formula. GDP deflator is equal to nominal GDP in a particular year divided by real GDP in that year into 100. Nominal GDP divided by real GDP into 100. That is into 100. That is GDP deflator. Now, I was telling about some items which questions where some items will be given, and you will be asked which concepts, which items will be taken into account and which items will not be taken into account. Like salaries received by Indian residents working in Russian embassy in India. Will it be taken into account? Yes, it is included in national income accounting of India, as this is a factor income earned from abroad. Okay. Prize won in a lottery. No, this is not to be included in national income accounting because does not correspond to any production of goods and services. Interest on public debt. The interest on public debt, this interest income will not be included in national income accounting because this type of fund is used by the government for consumption purposes. Okay. Profits earned by an Indian company from its branch located in, suppose, Canada. Profits earned by an Indian company from its branch located in Canada. Yes, this item is included in the national income accounting because this is again factor income from abroad. Value of goods which are produced by a farmer and kept for self-consumption. Yes, this is to be included in national income accounting because if the farmer is not consuming his own produced goods, he would have bought it from the market and then we would have taken into account. So values of goods, the farm products, which the farmer has he has produced by himself and he is keeping it for the self-consumption of the family, that will be taken into account. Imputed or estimated rent of an owner-occupied house, yes, that is to be included in national income accounting. So this type of question can be expected. So that is all I have discussed today about this big thing, the very, very important thing, national income. I hope this will benefit you. Thank you.